fundsupermart.com.
Hi, can you explain the asset allocation rationale behind this fund?
The real core of the fund is about delivering diversification, and we do that in a number of different ways. We're diversified across different asset classes, we're diversified across different geographies, and we're diversified across different parts of the capital structure. That allows us to pay a dividend yield of somewhere around 4.5% through the life of the fund. But more importantly, that asset allocation view means that we're able to do it with fairly moderate levels of risk. So we think of this fund as having a volatility, something like a 60-40 bond fund, around an 8% volatility, but with a payout of around 4.5%. The other part of our asset allocation process is really to try and buy assets that we think are cheap and try and avoid assets where we think are expensive. By doing that, by always making sure that we have a valuation cushion in the portfolio, we think we can deliver incremental and steady returns to our clients. We think we can deliver an above average dividend yield to our clients.
How has the fund performed in the past year?
We've done pretty well. When we look at the life of the fund, the annualized returns have been around 10% in the 5 years that we've been running the fund. I'm not particularly focused on the NAV returns. I'm more focused on delivering that steady, consistent dividend for our clients. So 10% a year has been pretty good, but markets have been pretty positive, both the equity market and the bond market. I think as we look forward, those kind of relatively positive returns are going to be harder to sustain and maintain, and that's simply because the level of bonds, the yield of bonds were probably unlikely to fall to the degree it has over the last few years. Equities probably have to do much of the heavy lifting, and certainly when we look at the asset allocation of the portfolio, that's how we're currently positioned. That's where we think we can add some value.
The returns of global bonds may prove challenging once the US Fed commences the normalization of interest rates. What are some actions taken by the team in view of this move?
I think it's right. A lot of people in the market worrying about when the Fed start to raise interest rates, but it's worth taking a slight step back and think about why are they raising interest rates. We would argue that interest rates are being normalized from incredibly low levels, really because the global economy is doing a bit better, and certainly the US economy looks, in our opinion, to be rebounding from the great financial crisis pretty strongly. That means that cyclical assets, equities, probably do quite well. Certainly when we look at our portfolio, yes, there may be small losses taken on the bond part of the portfolio, but the more cyclical assets, the equities, the REITs, I would argue, can more than outweigh those small losses. But sure, volatility is going to increase. Maintaining a nice balanced portfolio, maintaining a nice consistent dividend yield and not overreaching for yield will become much more important as the Fed starts to embark on its normalization cycle.
The JPM Global Income Fund had performed relatively better than its peers carried on our platform. How does the fund distinguishes itself from its Global Income Fund peers?
I think a lot of people out there perhaps have more high yield than we do. That's enabled them to deliver a slightly higher distribution than the 4.5% we're currently distributing. I actually feel quite relaxed about that. I think they're taking too much risk in the high yield market. I think that people perhaps are overextending in order to maintain those yields. And I think the fact this year that we've outperformed our peers, as high yield has come under selling pressure, as some equity markets have come under selling pressure, actually bears testament to our flexible, diversified asset allocation strategy.
Thank you.